Ask Kathryn Rooney Vera. She is head of research strategy at Baltic Capital Markets. Kathryn, never a dull moment these days. It seems nice to have you back with us.
Thank you, John.
Well, let's go through the two things that seem to be getting investors enthused this morning: rates and turmoil in the banking sector. First, on the turmoil front, are you feeling confident enough that the worst is behind us?
Well, we don't know that for sure, and the markets are, of course, trying to discount what they foresee for the future. So, again, the markets are getting ahead of themselves as they were at the beginning of the year, John, with that early rotation into the cyclicals and the growth stocks and remember the soft landing or the no landing and the immaculate disinflation. So the market is predisposed to think the best, in my view. And my view, John, is that has a lot to do with how we've been conditioned over the past 10 to 15 years, because we've lived the majority of those years in a Goldilocks scenario of low inflation and high growth, a scenario where the Fed doesn't have to hike rates and doesn't have to keep those rates up high for a very long period of time. And that in that environment, large caps do fantastic. Equities outperform bonds, and you want to look for risk. So that's the world we've lived in for the majority of the past decade or more. So I think there's a preconditioning there. I'm concerned about that. I'm continuing to be more cautious than consensus. And I do think that perhaps this banking crisis, maybe we're not calling it a crisis, John, but whatever it was, it's inducing a tightening of lending standards, which in and of itself can slow spending and change habits, which could accelerate or bring forward the recession that I've been calling for some time.
Let's dig deeper into that one. So there was a view in the market that if inflation could be tamed, and I'm going back, let's say, a month and a half ago,
right,
then we could be getting closer to the end of the rate hike cycle. And the bulls would say, well, that would be encouraging because you need that to happen for rates to peak before you can even start talking about being out of a bear market. And I know there are some bulls who will say, John, I think we're already out of the bear market, but we'll put that to the side for a second. The fact that there's a conversation now around a pause or perhaps a peak in rate seems to be largely driven by this worry about breaking more in the economy because of the banking turmoil. But also, you mentioned that very important point, which you've got all these banks that have to be more cautious. And in many ways, they're doing what the Fed might do through higher interest rates anyway. So how do you feel about the market's interpretation that peak rates is potentially a reason to buy? I think you already said you're a bit cautious on that view.
Well, John, you make a great point, and I hadn't even thought about it that way, but you're right. The markets at the beginning of the year were discounting a Fed that's potentially able to cut rates because, there's a soft landing, maybe no recession, but inflation immaculately comes down. And the markets rallied, right? Growth rallied and risk assets rallied, emerging markets rallied, the riskiest stuff rallied. And now we're seeing that again, Bitcoin's rallying, emerging markets. You mentioned the bull market. That's in tech. Tech now is in a bull market because it's jumped up quite a bit. And the market is now discounting that the Fed has to cut rates, but for a totally different reason. And that's because this phenomenon of lending standards is going to cause a recession, which takes inflation down, and the Fed cuts rates. The point here is that the market loves the Fed cutting rates. What happens when and if they do not, right? So my base case scenario is that the Fed this year does not cut rates. And my reasoning is, if you look at inflation expectations and Fed funds futures, there's this strange dichotomy, and I would argue a dislocation in expectations where you have year-end expectations of inflation higher than the target, about 3%, 3.5%, but you have Fed funds futures discounting rate cuts as soon as the summer. So that to me says that the market is banking on the Fed not taking seriously its 2% inflation target, which is where it went wrong for some time. So the Fed has to claw back credibility, and in my view, it's going to risk. It has two paths to choose. It can choose either economic growth that's mediocre but persistently higher than target inflation, or it can pick recession, inflation gets back to its 2% target. My suspicion is the Fed at this point wants to claw back inflation fighting credibility and is going to do what it takes to get back to that 2% target and will not cut rates before we get close to that target.
Okay, so we're going to take all of this and we're going to put it in the investor context. I'm looking at your bull tick research from a couple days ago where you reiterate the idea that being in shorter duration debt, not necessarily a bad thing. I dropped my pen. Not necessarily a bad thing to do right now. We've talked about the challenges with long-term duration debt. Cash or cash equivalents. I saw Bank of America's equity team was like, maybe cash is actually not a bad place to be right now. I see a reference here to gold. But overall, for equities, it seems like defense is your view right now on how to be positioned.
Well, the sectors that historically outperform have not disappointed, and we've lived in stagflation for the better part of more than 12 months now. The next phase of the economic cycle, let's think about it this way, John. It's unlikely to be expansion. It's unlikely that we've hit the trough. And economic cycles have peaks and troughs. So we're in stagflation, which is high inflation and low growth. The more likely scenario than expansion from this point is economic contraction with inflation finally dropping. So in an environment of recession, which we're not in yet, the defensive sectors are the ones we generally want to be overweight in. And those are healthcare, energy, utilities, and staples. I'm not going to move my call. I think it's the right call. And if you're a more conservative or moderate risk profile investor, I think it's where you want to be positioned. Yes, you can have equity exposure. I'm not saying sell everything, but you want to have an overweight cash position. You want to have a position in gold, and you certainly want to have a position in cash and cash equivalents.